The other day I came across a stockbroking website that had a graph that looked a little bit odd. And you know what I thought? It's time for Stupid Graph of the Week. Hi, I'm Phil Thompson. Thanks for joining me for Phil's Finance Fix. Now this week's Stupid Graph of the Week goes to that online stockbroking company that is owned by one of the big four banks that has a logo with a diamond and it's got yellow and black. But I'm not going to mention their name because, quite frankly, we live in a litigious society and I do not want to be sued by one of Australia's biggest companies. Now, I'm sure this is no surprise to anyone, but a stockbroking company makes money off people buying and selling shares. So it's not unreasonable to think that they have any interest in making people think that shares are a better investment than anything else. So why not make a graph to prove it? The graph in question is under the heading Why Invest in Shares, and it shows the performance of cash, property and shares. And guess which investment comes out the best? Well, shares do. And property not only underperforms shares, but it only just slightly beats cash. Now I'll just say right now, this graph in question is 100% technically correct. But it doesn't mean that this graph isn't misleading for two reasons. The property that they use in this graph and also the time frame that they use. When most of us think of investment property, we think of residential real estate. So the property across the road from yours that's for sale, or the investment property that you or your parents own. While this graph talks about property, they're actually talking about Australian real estate investment trusts. Now these investment trusts don't buy residential property. They're mainly made up of big commercial buildings, so like big shopping centres or the big office buildings in the city. And as you know, these buildings are leased out by businesses. And as you can see from this graph, it's just as affected by financial downturns like the GFC. Now I'm sure this online stockbroking company would say we're not being misleading because we are fully disclosing what property means. However, where I take a massive issue, the very next time they talk about property, it says, unlike property, you do not need a large investment to get started, which is fundamentally untrue when we talk about Australian real estate investment trust. In fact, you can buy a share in the A-REITs index for as little as $13 per share. And ironically, you can actually buy it through this online stockbroking company. The second reason this graph is misleading is because of the time frame they're using. They're using 20 years up until the end of 2012. Now this isn't just because it's 3.5 years old, it's literally the best 20-year time frame you could have ever chosen to prove that shares are a better investment ever since the property index was tracked. And you know what the funny thing is? A-REITs have actually performed really well over the last 3.5 years that this graph conveniently ignores. Now the data that I could get my hands on for 20 years up until 2015 shows that A-REITs are only slightly underperforming shares. But I guess this doesn't prove the point that shares are way better than every other investment. Thanks guys for watching, and if you are interested in comparing residential real estate, which is what most people consider investment property, and shares, then check out another video that I did and I'll link it below. And if you do come across a graph that looks a bit weird or stupid, then please shoot it into me. Thanks again, and I'll see you next week. The graph in question. Good enough.